Hello and welcome to episode 12 of the Technical Bootcamp. Today we are going to look at reading the market. So I'm going to show you how to read the story behind the markets using the concepts that we've been through so far in this program. I'm going to run you through some setups and show you how they're formed in real time on real charts, and hopefully prove to you that narrative building is the best way to trade, and maybe convince you to start focusing on that instead of random patterns. So with that said, this is the final episode of season 1, so it's a big one, it's an important one. Let's head over to the charts and start learning. Okay, so what we're going to do in this class primarily is just go through different market contexts and build out narratives and ideas around the market. Essentially, we're going to read into the story based on the information that we have put together throughout season 1 of the bootcamp, okay? So we're going to start by looking at this chart, and we're going to start pretty much from what we can see and determine basically who is in control and where do the opportunities lie, all right? So what we're going to start by doing is taking a look at the downward trend. Here, initially, as we can see, this market was shifting to the downside. So this was a bearish market and something we would generally just look for continuation selling into. So throughout this downward move, the standard thing to do really would be to just look at selling from supply zones, all right? Because of course the market is down, printing lower lows and lower highs. Therefore, it's telling us structure is bearish, sellers are in control. Now, if we take a look at the momentum as well, this is something we discussed. We have slower, choppier, more sideways upward movements like this one here and this one here. And then we have very clear, strong and fast downward movements like this move here, the one previous to it there, and then the initial movement, of course, over here as well. So we can basically determine that all of this range that we can see up to about this point is clearly seller dominated. Okay. And the idea would be throughout a seller dominated market, you just want to continue looking to sell. All right. Now, with that in mind, we do see at this point where we start to push over this high. So with that in mind, a clearly seller dominated market, we do have this lower high, which if we take a look at where the market is trading more currently, we see that the market broke above that. So on the surface, this could be indication of a change in the trend direction. What we can sometimes presume from here, or most of the time presume from here, will be that the market is going to create a higher low and then drive up into a higher high, which would require the market taking out this high. So from what we can see contextually, we have a downward trend with clear seller domination. Then we kind of stall out on that seller domination around this point, because as we see, we didn't successfully make a new low yet. And then we actually shift the other way. And these impulsive downward moves we've been getting, which are very strong and fast, are actually replaced around this point with pretty impulsive buying moves. So we have a reasonably fast push up. If we compare the movement that we've just marked out here with any of these upward movements previous when the sellers were fully in control, we see that this is a much more impulsive and strong movement. We basically find our low here after losing downward momentum here. And then we see this big rally where we have a reasonable amount of strong bullish candles. Yes, we have some chop, but we don't have much pushback from sellers. So the buyers actually maintain reasonable control through this drive up. Now, then we have this downward move, which is a corrective pullback move. Comes back about 50% of the upward move, a little bit less than 50%, I believe. And then we have a very impulsive bullish buying move from around this low up to this high. This one is showing pretty clear buyer domination. So this is actually basically this phase from the low to the high. This is a more buyer dominated phase, right? If we factor all things, structure, number one, lower lows and lower highs, shifted at this point into a higher high, giving first indication of buys, potentially being the movement to make. And then momentum, we have slow choppy upward moves, strong fast downward moves, slow choppy upward move, strong fast down move. And then we actually shift that and start going pretty strong and fast to the upside with a slower, choppier downward move. So we're kind of seeing a crossover point between buyer and seller domination, okay? And we draw this from looking at the candlesticks, the speed of the movements taking place, looking at the structure, the highs and the lows, and the way the market is printing those highs and lows. So for the sake of this, just to make sure everything is mapped out, I'm going to draw out the breaks of structure on the downside, okay? So to mark the structure, you see this is kind of the shifting point where we end up breaking above this previous high. This is where we start to really read into what the market is telling us, because of course we've derived a fair bit of information from this, and as of right now we would be essentially in a position where if we'd have pulled back to this point and traded into this demand zone, we could have looked for a buy opportunity, right? And I'm sure a lot of people, or a few of you, have seen that and thought, well, that's where we would have wanted to buy, okay? But there is one problem here, and this is why we have to really read into markets. And this is that although we did indeed break structure around the point here, we actually have a slight problem. And that is that in this seller dominated market, this could potentially be, right? This entire movement up could potentially be a pullback. And the reason we say that this can be a pullback and what we could classify as a liquidity sweep is because if we take a look over here, so we're going to look into this range now. There's a couple things to be aware of. First of all is around this area, we've got a collection of equal highs. We've got 1, 2, 3 equal highs just there. And then we've got some more relative equal highs. Now these equal highs create liquidity, right? That's what's going to act as a magnet for price to be drawn into. And liquidity can create either strong continuations, or if the orders are absorbed, then we see reversals. So to explain this, and this is fully explained in the liquidity classes in the bootcamp, this area of liquidity is basically a big collection of buying orders. We have stop losses from sellers under this high. Those sellers will be forced to buy back contracts if the stop loss is hit. So that's a collection of buy orders. And then we have buy stop traders who are looking to automatically enter trades if the market pushes through the high because they see this resistance as something that will break, retest, and continue higher if it's broken. So this is a big pool of buy orders, okay? What can happen is when the market comes into this, we can see absorption of these orders and large influxes of selling to drive us back to the downside. So that's definitely point number one to consider. The equal highs being taken out kind of aligns with the actual break of structure that we get, right? We're going to kind of drive into a pool of liquidity. And I guess we could even say the same thing around here, though I would be more interested in seeing the actual swing high. As well as that, more importantly than that, if we look over here, we have imbalance. So an imbalance is basically an open price range between where a supply zone is and where price currently trades. This imbalance is existing pretty much beneath this level. We have a supply zone just here, we'll mark it on, and then a large impulsive drive to the downside that up until this point in time was not retested by price, okay? So what does an imbalance show? Well, an imbalance, because obviously what we're doing is reading the market, is basically a large impulsive movement created by a large influx of sellers who see a premium price level, or in a buy side example, buyers who see a discount price level, such as the demand zone just here. And the imbalance is created by a mismatch in transactions, essentially. So it's a point of clear seller control in this initial example. And this clear seller control has basically meant that the market is driven down so quickly due to so much pressure that it has not yet been able to recoup any momentum to draw back towards a premium price level. However, imbalances as we know them are generally going to be kind of a magnet for price, right? Because what actually happens is if we've seen so much influx of selling pressure coming from a supply zone, which is proven at this point by creating supply and selling off, this then is seen as a premium selling point. And if you're a seller, you want to sell at the highest premium possible, right? Whether you're a short seller, you want to get the best entry, that's going to come from a premium, or whether you're a buyer who wants to sell their contracts, you also want a premium price to do that. So with this being a proven premium price, we have risk that if the market returns to it, even if it looks like it's created a break in structure, and even if we look like we're shifting control to buyers, it can create pretty strong, fast reversals back into the overall trend, right? So this is basically, one of the big considerations when you're doing analysis is if we start to break structure, where are we actually breaking into? Are we breaking into a safe point to confirm the upside? Or are we breaking into a point that potentially could actually be just exhaustion from sellers because they're not happy paying these premium prices down here or transacting at these premium? So the question becomes, when we're trading down here, for example, is this clear buyer domination to lead into new upside? Or could this just simply be the fact that sellers down in these more discounted price levels are not happy to sell in massive quantities and they don't want to open huge sell orders down here? They would prefer to open huge sell orders once market had returned to a premium price level, right? That's the consideration we're looking at. And that's why it's so important to consider liquidity, imbalances, supply and demand, all of these factors in conjunction with one another. So what we would be looking at really in this instance is if we had followed through this piece of price action we have, we'd now be at the point where we're questioning, is this buyer domination or is this seller exhaustion? And buyers have managed to take control due to lower transacting from sellers, lower frequency of transacting from sellers, because they want a premium price to be met before they sell, okay? That is how I view this market. So to recap how I view it, I see seller domination shifting into potential buyer domination, and due to the imbalance, the liquidity, and the open supply above, we then get the new question, is this buyer domination or is it seller exhaustion until a premium price is met? So how would I then face this? How would I trade this opportunity? Well, this is the simple reason why I wouldn't have been taking any trades at this demand zone. Now, obviously, with the benefit of hindsight, if you'd have bought in from this demand zone, having seen the shift in control from sellers to buyers at this point, you would be running a good trade. You'd have entered here, your stop would be down here because the rest of the range is efficient, and you'd now be running up here and you'd have a good profit. But there's the risk here that you, by buying there, wouldn't have a full understanding of what the market is actually doing. You would have had to ignore or miss information, this information here, to actually safely or happily execute there. If you want a good, smart, safe execution on all of your trades, which we do, we want to make sure all of the information we have in the market aligns with our idea and gives us agreement before we start executing. So how I would prefer to approach this myself would be, I would like to see the market start pushing price to create supply fails. So when we have a supply zone, we know that it's only good one time. Okay, so it's good for the first tap. After the first tap, the supply zone is getting weaker. And the reason that a supply gets weaker after every initial tap is simply because the idea behind suppliers, we are judging to see a significant influx of selling pressure, which if this zone is strong, should drive us into a bearish impulse. But if we only drive into a corrective move like this, where we don't break through a previous structural low, and then we are able to return to the zone again, well, that tells us that there isn't such weight of sellers in here anymore. We don't have that massive influx of selling coming in at this level as we did when we were at this level previously. This influx of sellers created impulses to the downside. This influx of sellers has just created a corrective move. So there's a lot less sellers here than there was before, which means if the market's able to reach back into here, rather than looking for an extension to the downside, we would be more inclined and more expecting to see a continuation to the upside, because a drive back in there or even above there would basically indicate to us this supply zone is no longer of interest. So how would I like to trade from the position that we're in right now? Well, there are two things that we would look for. First of all would be the simple idea of seeing this as a liquidity sweep and taking this market to the downside. We would mark out this swing low, and we would say if the market is able to get under this swing low, then that counts as our one tap into an impulse to the downside, breaking into a lower low. Therefore, the standard opportunity would be to pull back and sell the market like that. Okay, so that would be it. Nice and simple. We'd be looking at continuing the downward movement after a sweep of liquidity, after a fill of this magnet imbalance, and after a retest of the supply zone above. But the alternate way that we would look to trade this would of course be with the considerations we just put in place, which is that this could be a crossover into buyer domination. And if we can prove that via weakening this supply zone or failing the supply zone entirely, then we can take buys. Because what that would do, if we were to drive up, is it would validate this low here as our new higher low. We would no longer have to focus on this area, and we would have a new fresh leg of price action like this, of which we would just look for the clear demand zone, which in this case is going to be this one, and we would buy from this demand zone once the market returns to it. So that would be where the next opportunity would come from, right? So what we've done here is create something that you'll see in my trading I do a lot, and this is what I teach inside of my program. It's my system, which is a if this, then that format trade, right? This is kind of a glimpse into the way that I operate there. So what we're trying to do is create situations where if this happens, then this action is taken, okay? So if we take a look at the first instance, and the reason I'm telling you this is because this is how I believe you trade brilliantly. This is the best way to trade in my opinion. We said if this low breaks, then that would create validation of downside, then I would sell, right? But if this high breaks, then that would create a new leg of price action. It would create a supply fail or supply weakness, and then we can buy. So by creating these if this then that scenarios in your trading, what you do is you use all of the information you've read from the market and you create simple scenarios that you simply trade in whichever direction the market tells you to trade them, okay? And this is how we read the markets based on the information I've given you. We're not trying to see the future or do anything mystical or magical. We are simply reading the information the market's given us in the way that we have, and then creating simple if this then that scenarios out of it, okay? So let's take a look what happens next. In this particular market, we see the market drives up. And this push here has done two things. First, it weakened the supply zone by driving into it with this impulsive push. Second, it failed the supply zone. By pushing over the high of the supply, this point here, it tells us that this supply zone is no longer intact at all. If the sellers were here, and if this was still seen as a premium price for this market, then there is no way we would have been able to push through the high, because the influx of selling we would have seen would have been strong enough from here, inside of the zone, to drive it to new lows. The fact that we've taken out the high, even if just with a wick, tells us that that large amount of sellers is no more. And there's actually a larger amount of buyers because they've been willing to take the market over, right? We see willingness to go higher, but we don't see willingness to drive lower. So therefore, this is now validated as a new leg of upside. And what we want to do is just simply treat this buyer domination as what it now is. It's proven to be buyer domination at this point, okay? So we can draw it back to the initial trending movements, which was, first of all, the market was trending down. Then we started to see that buyer domination, slower seller pullbacks, buyer domination, slower seller pullbacks. And then yes, this is a trickier movement. This isn't the strongest looking move in the world from a momentum perspective. But if we think about what this really did, it's actually a very significant drive, because what it's done at this point is prove to us that this initial supply zone is no longer strong. And what we want to do is take this market higher because the buyer domination is now baked in. So we have room for a setup. Now let's get into that. The first thing we would like to do, once we have broken through and created this supply fail and proven the first initial if this then that situation to be true, the buying opportunity and the buyer domination, is identify where we would like to target. Now, the most simplistic way for us to identify some form of target is just going to be to look at previous imbalances, previous supply zones, points of interest like that. I would simply say, now that we've broken through this high, we are likely to drive through the remaining imbalance towards the extreme supply. Now, there is possibility that we also end up taking out these highs entirely, so driving all the way over these points. But the most simplistic way for us to trade this now is just to look for the next clear point for the market to reach to. Now, if we look over here then, we've got a bit of imbalance there, not too significant of a high, bit of imbalance there, again with kind of equal highs over there. And then a bit of imbalance driving into this zone, which we could actually see as the extreme because everything previous to that is efficient. So to draw back to that, an efficient zone is basically a zone or a phase in the market where every single time we create a supply zone, the market draws back in and retests it, right? So we have supply there, retested there, supply there, retested here. That is efficiency. Now, an inefficiency, or as we know, or an imbalance, is where we create a supply zone or a demand zone, and then we don't pull back. So we leave an open price range like this. Now, this drawn over here, basically, we have our efficient range here where all of those zones have been retested. And then our inefficiency is this point here, the final imbalance and the final supply zone that has imbalance before the market breaks into an efficient range. So for a target for a trade, we basically can say if we mark out this supply, the final imbalance supply in this initial movement, we should at least reach into there, even if the market then creates reversals once that zone has been met. So this becomes a very safe and clear target for us to trade, okay? So what we've done reading into that is basically identify multiple points of imbalance and then decipher that, look, the most probabilistic one for us to trade into is going to be the highest because as soon as we drive through one imbalance, we're likely to drive through the next and the next. These are not strong highs. This is basically essentially we can view this as kind of one large imbalance with little stalling points on the way down. But when we break back into it, we would anticipate a full fill of all of them. So that's going to be our target. Now for our entry, it's actually very simple. We've identified that inside of this upward move, we have a clear demand zone, which created a large impulsive drive. And bear in mind, this is the impulsive drive that's driven to a supply fail and a break of structure. That's going to be just there. We've also got some kind of relative equal lows around here in the market. Okay, so that basically draws us towards that point. So that should be a magnet that puts us off buying above that level. And then we know that this extreme demand is where the likely possibility is going to come from. Now, looking previous to this range is now efficient. The remainder of that range is efficient. And then everything before this point is also efficient. There's no open imbalance supply zones or demand zones inside of this movement. So really the only logical place for us to take a trade from is going to be this one. So we could buy from there and we can target there. And for simplicity's sake, because the market allows us to in this instance, I will put my stop under this low. You could realistically put it under the demand if you wanted to, but we're going to keep it super simple for, a more risk-averse approach, okay? So then from what we've read from the market, which is basically that crossover from buying or from selling control into buying control, and then the reads of everything else we've done to determine where the market's likely to reach into and why, where the market is likely to enter from and why, we basically have now formulated a full setup, okay? And what we've done here, as you can see, is not just look at patterns, we've deciphered what is going on. Right? It's a clear point of sellers were running this market. Sellers lost steam down here. Sellers had one final opportunity to bring this market down from here, but they failed. So now we absolutely should be on the side of the buyers. Buyers are now likely to take the market up to fill deeper imbalances, potentially trading through new highs. But if sellers are to step back in, the most likely point they do that is here. So if we take our profits here, we avoid a sad scenario where the sellers retake the market and our trade gets killed. So we've built essentially a story of what's happening behind those candles, as opposed to just what are the candles telling us on the surface. All right, so now let's allow this trade to play out. You see there, we get a tap into that demand zone. We start to rally and the market drives towards the upside. We end up taking out the new high and we drive through to tap into the area of supply. So your trade would look start to finish like this. This is the opportunity that we derive from that. Now, if we consider what has happened here, to just read a little bit deeper into it, we see sellers come down to the demand zone. Then as soon as we hit this demand, we have this large influx of buying. This then leads into some buyer domination through this drive up. And then when we hit that supply, we do indeed start to see some sellers coming back in to attempt to reverse this market. Of course, they failed. The market didn't get down under the low, which now that this new leg of price action is created, would be this point here. If the market had shifted from there and drove down through the low, then that would have created a new if this then that situation. If the structure breaks, then we look to sell. But instead what we did was create around a 50% retracement, and then we rallied higher. So this creates again another if this then that situation, because we can read from this market that, okay, this supply fail, this drive over this high, and this failure to break the low validates to us buyer domination in this market. So if this high breaks, then we can buy pullbacks, is the way that we generally approach the market. All right. And you can see every step of the way, what we've done there is use the concepts I've showed you to read behind the markets and read what's actually going on underneath the surface level view of just candlesticks on a chart. Okay. So hopefully that makes some sense. And I'm sure that this has given you an insight into how we actually read that and trade it. A quick interruption from today's class. What you're learning here in the bootcamp about technical analysis is necessary to being a good trader, and I'm sure you're seeing that now. But technicals alone are not quite sufficient to get you to where you want to go in terms of getting funded or reaching payouts or making money from trading. Most traders don't actually get stuck because of what it is they see on the charts. They get stuck because of the habits, risk behavior, decision-making under pressure, and self-sabotage patterns that form that don't show up in technical analysis. So I've created a simple 15-minute class which is going to help you to transform your trading from behind the scenes, fix the way you operate away from the charts, and all of this stuff is what really matters. It's simple, it's small, it's easy to watch, so go and check that out. There is a link in the description to that. Watch it after this class, but not right now, don't jump ship. And with that, let's get back to the bootcamp. Okay, now for another opportunity. This one was Euro USD. So this market, if we look at it from this zoomed out perspective, we kind of see a phase in the market where we've seen seller domination up to this point here. And then we've started shifting into what looks like a buyer dominated market, okay? You take a look at this upward move from this low upwards, you can see each of the bullish movements is notably stronger than the bearish pushbacks we get. The impulsive moves are bullish, the corrective moves are bearish. Specifically over this phase, we see strong, fast buying moves and we see slow, choppy pushback moves. So obviously that momentum helps us to see that buyers are controlling this market. Okay, so what I initially wanted to do, this is a trade that I actually took, was to buy from the extreme point in this trend, given that we had this buyer domination. Okay, we can even see up here, although not a very strong break, we did start to see willingness to go higher, essentially invalidating this high, though not really proving much with it at this point. So I don't really see this as a viable higher low. There's a couple reasons behind this. First is we've got that relative equal liquidity, 1, 2 there. Second is this break is really just not impulsive or strong enough to determine this as a new high. So I kind of see this just as one solid movement, all right? We have a clear higher low here. If this was to break, that would validate a shift into some downward movements. We'd be able to trade through this sufficient range towards demand here. But as of right now, providing we stay above the marked low there, we should remain bullish. That's the general idea we can get from this. So in a buyer dominated market where we clearly see buyers in control, we want to buy providing we get a discounted price to buy from, okay? So why do I want to buy from this point? Why does this strike my attention? Well, first of all, it takes out liquidity under this low and under this low just here. So we have this kind of what's classified as inducement, or something we're going to get into soon, and this area of equal lows being taken out by price. Therefore, we would not want to buy above this level, Okay, so now that we're beneath this level, we see the imbalance. What does imbalance tell us? It tells us that beneath the imbalance was a strong influx of buyers. They see this as a discount price level. So if we know that traders see this as a discount price to buy the asset, we can safely presume, providing the market structure stays up, that when the market gets to this level, we can again be looking for a new influx of buying to take place. That is the general idea we form here. So if we know that buyers are controlling this market, and we want to see buyers reclaim control of the market after a pullback, but we have imbalance and we have an open demand down here, that creates a situation where we can actually look for a sell like this, right? Why? Because we understand what the market's doing. The market is drawing back towards an area where potential buyers can come in. But before those buyers are going to be happy to transact in mass, we need to see a discount price level met. So that creates a situation where, factoring this as kind of a internal trend instead, we see a shift which is likely to take us lower into the discount price before we start going higher. Okay, so grabbing our rectangle tool, we're going to look at this broad range here as a point of supply. So this is basically a sideways consolidating move before an impulse to the downside. We know that the market's going to be drawn lower, so we can potentially use this point to sell towards the discounted price range, where buyers may then step back in. So reading behind the candles here, what we're doing is basically taking advantage of buyer exhaustion. We know buyers want to be dominating this market, but they don't want to transact at these high prices. They want a discount. So the buyers are not going to be as strong here as the sellers will be, because the sellers are happily selling in this more premium price area before we reach a discounted price where buyers will see this as a good deal again and re-enter the market. So then I took a look at the hourly time frame, and I saw that if we factor the consideration of imbalance and balance, inefficiency and efficiency, taking a look all the way through this entire movement, every supply zone that's been created up to this point has been retested by price, except this point here, this final hourly sideways movement before the impulse to the downside. So this becomes what we classify as the extreme supply. It's the final supply zone in this trend that makes sense to sell from. Now, obviously factoring that we are targeting this level, that's going to be where we want to drive the market into. And yes, the market could actually just run down like this towards that level. There's nothing really stopping it from doing that. But that wouldn't give us an opportunity, because we know this is then seen essentially in the confines of this range as too much of a discount price, and we want to sell from premium prices. So we would ideally want the market to return to what is seen as a premium by the marketplace, and when we reach that level, that's where we could execute our sell. So why do we look at this supply at the top? Well, the reason is obviously anywhere really in this range is too low for us to be selling there. We want to sell premiums. Number two, we take a look at what's going on up there. We have an imbalance, and then of course it's the extreme. It's the final supply zone with imbalance in pretty much the extending move to it. So that's going to be the point that we would want to sell from if the market is able to reach back up there. What we would do in this case is place a short, stops over the high. We can put them just over the zone because this is the structural point too, and then targets down into this low. And then the idea would be that what we can do is if the market does return to that supply, we are automatically sent into a sell to target this low, following the buyer exhaustion and kind of short-term seller control we're seeing towards that imbalance fill. So now let's run the market forward, and you will see that we get a rundown towards that level quite cleanly. Now this situation is actually a lot nicer, a lot smoother than the previous example that we looked at. The reason I shared with you the previous example is because sometimes markets are going to be like that. In fact, a lot of the times markets will provide you with tricky price action that you need to kind of work your mind around. This one was a very clear idea. We had a simple buying opportunity, and we saw exhaustion stepping in and the market being drawn by that magnet price of imbalance and demand, discount price range, to drive the market lower. We understand that's the next most probable move. So what we do is just join that buyer exhaustion, that short-term seller control, and take advantage of any opportunity we can from the more near-term premium price levels to take this market down into what can potentially be a buying zone. Now, as you will see, we actually ended up creating a demand fail, which in this case leads us to believe that the more likely outcome now would be if we do get any pullbacks, potentially leading into sells. Now, I'm pretty sure as to where the market went next, actually ended up rallying a bit, but that is generally what we would derive from this market at this point in time. Okay, we would expect to see some pullbacks, then we would expect to see the market go lower because this demand has changed on us, right? With this demand failing, what does that tell us? Buyers are no longer interested in this as a strong discount price level. Therefore, if we do start to see buying, it's more likely to be a sell the rally situation, then a reversal to the upside. But drawing in on this setup, you saw how simply we brought that together. And again, it's all about reading the story, okay? You can see how that brings so much clarity and confidence and kind of relaxation into the trading I do. I'm not a pattern trader per se. I am looking for the reasons, the story, the logic, the narrative, and turning that into opportunities that just make clear logical sense. When you understand who is in control at which point in the market and where that control may shift, you understand what is exactly going on right now, it's easy to take trades because the trades form right in front of you and you know exactly what the market is likely to do next. Of course, it's all probabilities based, and yes, things can change and trades will lose. You're never going to win every trade, but when you understand this much behind the market and when you're reading into it like that, it's so easy to take those trades with conviction because you're not just going off of this is what the pattern says. You're going off of this is what the market and the participants in the market are subliminally telling me through the structure and the formation of these candles. So hopefully that makes sense. Okay, so that brings us to the end of season 1 of the bootcamp. I hope you've enjoyed it so far. To run through everything we've really learned and the big focus for season 1, the big focus was on reading the why behind the market instead of just reading the what of the basic patterns. I want you to start looking at markets as a story. The lessons, the information, the things that you're being told by the candles and price formations. Momentum, supply and demand, structure, liquidity, imbalances. Everything we've been through so far is about reading the story behind the candles. And these concepts that are grounded in logic create clarity and high accuracy in the way that you trade. So the core takeaway from Bootcamp Season 1 is to trade narrative and context over just basic patterns without explanation. If you do all of this and you trade in the way that we've just explained, your trading will change dramatically for the better this year. If you're watching this the day it comes out, do not worry, we'll be back very soon with the bootcamp. And until then, we have some more learning to be done. For now, head to the link in the description and watch that class. That's going to help you to diagnose what's going wrong off the chart instead of just what's happening on the charts that's holding you back from success. And if you want to go deeper, there's a second link under this video, which will show you my program, which is where we actually take everything you've learned in this bootcamp and systemize it so you can understand the flow of exactly how I trade. So with that said, hope you've enjoyed this class. Thank you for watching, and I will see you at the start of season 2.